the cost of goods and services in the U.S. increased at a slower annual rate than anticipated for January. Let's go to Oscar Munoz on this, Chief U.S. Macro Strategist at TD Securities. Thanks for joining us today.
Thank you.
This period would include the government shutdown time. Now, if they didn't collect data in that period, would that throw off the number they came up with for January?
No, I don't think so. I think this is one of the cleanest reports that we've gotten in a good while. I think you can raise some questions for the November data and perhaps December, but I think January was pretty clean. So I probably take the signal from this report fairly straight. I don't think there are a lot of blemishes on it.
Okay, let's talk about what came in. Prices were down pretty much across the board, but there's an exception for transportation, for example. Any reason why?
Yeah, I mean, airfares were pretty strong. It's usually a very volatile segment, so it goes up and down depending on the month. So I wouldn't take a lot of signal from it. I think the main signal, I guess, the main takeaway is that if you wanted to see evidence of disinflation, I think you can find it in this report. We're looking for a stronger print for the core in particular, but services inflation, even with that strong transportation segment that you're mentioning, just came in softer than expected, right? Also, if you look at core CPI inflation on a non-seasonally adjusted basis, it was the weakest month-on-month print for any January since 2021. So we're basically back to the pre-pandemic pace, and that's good news at the start of 2026. So some green shoots in the report today.
Okay, let's talk about food prices for a moment, if you don't mind. They do appear to be easing, and I know grocery prices generally have been on the rise across North America. Was that a surprise to you?
It was a little bit of a surprise, yes. I think food prices in general, the whole segment was a little bit of a surprise. For us, it was mostly food away from home. We're penciling in a stronger increase, but it actually came down, and that's the prices associated with food services spending, restaurants, right? So that's good in terms of the thesis that maybe the labor market is not overheating, and you see that through the recent disinflation in that segment. So I think in terms of services, it's good news, and this is going to show up even more in the core PCE number that we're going to get for January.
Okay, so let's talk about tariffs, because many people thought that some of the tariff pass-through would be happening now, the start of the year, maybe that the people who were selling goods were absorbing those costs, and now they were ready to pass them on to the consumer. Are there any impacts from tariffs in the read that you have or for CPI?
Yeah, certainly there was a big impact, right? If you look at, for instance, the CPI supercore, it was very strong, 0.6% month to month. Some of that increase certainly reflected tariff pass-through, and you could see that as well in the goods basket. Once you strip out, vehicle prices, it was a significant increase as well. So it means that the tariff inflation story is not over yet. We think that it should continue to play out over the next couple of quarters, but it should no longer be a meaningful driver during the second half of the year.
Okay, talk to me about immigration policy, which has dramatically changed sort of what the U.S. looks like. How is that affecting the cost of goods?
It's hard to tell, really. For me, maybe where you can see it is in overall demand dropping, so maybe on the services side, but it's a little hard to pinpoint exactly in which sector. For me, it could be a story for the housing segment, perhaps down the road. I don't think it's a big driver for housing disinflation just yet, but it could be a driver toward the end of the year or even 2027, right? If people are not coming into the country, they're not going to look for housing. So housing demand will be weaker, and that should be reflected in the slowing rent prices and also OER.
With the CPI read that you have now, has that changed your calculus on the rate path for the year?
Not really. We do still expect the Fed to ease further this year. We just think that the Fed's rationale is moving from risk management cuts and concerns about the labor market last year to a disinflation story in the second half of the year, which, if that happens, it should open space for the Fed to resume easing. We still expect the committee to cut rates by 3 times this year, 25 basis points each. In June, September, and December, to a terminal rate that we think is at 3%.
So you think that it will no longer be looking at jobs and weakness in the labor front, that it will move to more inflation, and though inflation has moved down to 2.4%, that will still be the focus?
Yes, so I think just the labor market, and we saw it in the payrolls report earlier this week, is just stabilizing, right? There was a lot of concern about labor market deterioration, particularly since the summer and through the fall. I think the most recent jobs report, when looking at the household survey, the unemployment rate dropping from as high as 4.6% to 4.3%. I think that basically spells a stabilization of the labor market. So that allows the Fed to focus on the other side, right? The other mandate, to focus on inflation. So if inflation starts to go back to the path of back to inflation at 2%, I think that should open space for the Fed to ease. But we need to see more progress, and we think that progress is probably going to be more visible in the second half of the year, which is where we think the Fed could resume easing.
All right, Oscar Munoz is going to leave it there. So thanks for joining us today.